On the 4th of August, two contracts were signed over the same building in Norway. The lease on the building runs 16 years. The deal for the chips going inside it runs 6. That gap is not a detail. The AI build-out has quietly split into two assets, moving in opposite directions. And the money behind it is priced as though they were one. Which means somebody has put in writing what a used AI chip will be worth years from now. So here is a bet you can hold me to. By the end, I will name the companies this pays, ranked, and the one quietly carrying the risk, dated, and with the thing that would prove me wrong. Follow the money down with me, and you will see it before I say it. Start with the deal itself. A company called Volta launched out of stealth. On the same day, it announced a computing agreement worth about $10 billion over 6 years. The customer is described only as a leading AI lab. Bloomberg reports it is Anthropic. Here is the odd part. That same day, Volta was valued at $2.4 billion. It had raised $300 million from Andreessen Horowitz and Altimeter. NVIDIA and Michael Dell joined in. A company worth $2.5 billion had signed a contract worth $10 billion. The obligations are supported by roughly $1.3 billion in letters of credit, arranged by JP Morgan and another major institution. So the credit is not really Volta's. It is passed through from the people standing behind it. And there is a second thing Volta does not have. It does not own a data center. It leases one from a Bitcoin miner. That sounds like a punchline. It is actually the most rational part of the whole arrangement. The scarce thing in AI right now is not chips. You can buy chips. It is land that already has electricity. A building with a finished grid connection. Getting a new one can take years of queuing. Bitcoin miners spent a decade acquiring exactly that, and they are now selling it. More than $70 billion of AI and high-performance computing contracts have been announced across the listed mining sector. The building in this case is Bitdeer's Tidal campus. The agreement covers about 121 megawatts of computing capacity. That is drawn from roughly 133 megawatts on site, running on renewable power. Into it goes NVIDIA's newest hardware, supplied by Dell. And here is the number that gives the game away. Bitdeer's lease on that campus runs 16 years. It is worth about $4.7 billion, with an option that extends it to 24. The compute contract sitting on top of it runs 6. The people who own the building signed up for 2 to 4 times longer than the people who own the machines. Bitdeer's shares rose about 23% that day. Now widen the lens, because the same shape appears again at 10 times the size. Earlier this year, Apollo and Blackstone closed a $35 billion vehicle, reported as the largest private credit transaction on record. Its job is narrow and strange. It buys Google's AI chips and leases them to Anthropic. Lenders do not hand over $35 billion on a young company's promise. So Google guarantees the payments on the capacity across 5 sites. Reported lease guarantees run to around $44 billion. That sits inside a financing program trade coverage puts between $150 and $200 billion. The chip supplier is also the one standing behind the rent. But look closely at what that guarantee actually covers. It answers one question: will the lab pay its rent? It says nothing about the other question, the one hanging over a 6-year lease, on hardware that gets replaced every couple of years. What are the machines worth when it ends? Somebody did answer it, in writing. Broadcom, the company that co-designs those chips, provided a residual value guarantee. It is a promise to cover the gap between whatever the hardware fetches at the end and whatever the senior lenders are still owed, reported to cover roughly $30 billion of that debt. And that single promise is reported to be what moved the senior tranches from junk-rated toward investment grade. The paper is not priced off the lab. It is priced off Broadcom, which makes that guarantee a bet on how fast the technology improves. And that is contested ground. The big cloud companies write these chips down over 5 to 6 years. Critics, Michael Burry loudest among them, argue the real economic life is closer to 2 or 3. He estimates that difference could flatter reported earnings by more than $176 billion between 2026 and 2028. And there is a reason to think the shorter number is the honest one. It comes straight back to the building. In a hall where power is the hard limit, an old chip is not a cheap chip. It is a chip taking up electricity a better one could use. Once its work per watt falls far enough behind, it stops being worth running at all. Its resale value drifts toward nothing, whatever the accounting says. The very scarcity that makes the site more valuable every year is what destroys the machines inside it. The honest counter is real, and it is the thing to watch. Suppose demand for older chips holds up. Suppose there is enough ordinary inference work to keep them earning. Then a deep second-hand market forms, and end values hold. And these guarantees are never called. In that world, the whole structure looks conservative rather than fragile. That is the case against everything I am about to say. So that is the machine. Now the bet, dated, named, and with the thing that would prove me wrong. Here is the call. Through the end of 2027, the money in AI infrastructure keeps moving from the silicon to the sites. Energized land with a grid connection keeps getting contracted at long tenors and rising prices per megawatt. Meanwhile, the assumed end-of-life value of AI chips gets quietly marked down. And if that markdown comes, the first loss does not land on the AI labs. It lands on whoever guaranteed the value. The direction is clear. The timing is the open question. So here is who this actually pays, ranked by how directly they own the appreciating side. First, Bitdeer. It owns the building on a 16-year lease, and the market repriced it about 23% in a single day. Second, the rest of the X-mining operators, Iron, Core Scientific, TeraWulf, Cypher, Hut 8. The same trade, with more than $70 billion already contracted. Third, Nvidia. It sells either way, but it now has to match this credit structure or keep paying more to finance the same hardware. Now the other side of the ledger, the ones carrying risk rather than upside. Alphabet guarantees the rent, which only depends on the lab paying. That is the smaller exposure. Apollo and Blackstone hold the paper and earn the spread on it. And last, Broadcom. It guaranteed what the chips themselves will be worth, over roughly $30 billion of senior debt. That is the seat with the least upside and the most to absorb. And the falsifier, the thing that would kill this call. Watch the next annual filings. If the big cloud companies lengthen rather than shorten how long they depreciate these chips, the market disagrees with me. The call dies. If a deep secondhand market clears strongly on inference work, it dies. And watch the Norway phases. They are due at the end of this year, and in March, if they start on schedule and a second vehicle of this kind places on the same terms, the structure is working. I am early at best. So, plainly, the winners are the people who own the power. Their asset gets scarcer every year, while the thing plugged into it goes obsolete every 2 or 3. The site appreciates. The silicon depreciates. That is the whole trade. And if it turns, the first loss does not land on the AI lab everyone is watching. It lands on whoever signed the promise about what the hardware would still be worth at the end. That is on the record. Today, the 4th of August, 2026. The first checkpoint is the end of this year, when the first Norway phase is due. The second is the annual filings that follow. We will come back to it either way, including if it goes against us. Everyone is asking whether the AI companies can pay. The more useful question, the one an entire debt market now quietly rests on, is what a 4-year-old chip is worth.